Today we're going to explore a fascinating trading tool called the Step Channel Momentum Trend by my favorite, choppy. This indicator is special because it gives you a very clear way to see whether the market is in a strong trending phase or if it's just moving sideways in a choppy range. In this video, I'll walk you through exactly what this indicator is, how it works behind the scenes, and the different ways you can use it in your trading approach. And of course, if you find value in this explanation, do me a favor and leave a like. It really helps. Alright, let's get set up. To use this tool, you'll need to be on TradingView, the charting platform I'll be demonstrating with today. If you don't already have an account, then no worries. I've included a link in the description where you can sign up. Once you're logged in, just open a chart of your choice, click on the Indicators tab, and type in Step Channel Momentum Trend. That one you want is by choppy. Big shout out to them. Now, let's talk about why this indicator is so different from the usual momentum tools. Many traders are already familiar with popular indicators like RSI or MACD. The problem with those is that they rely heavily on something called smoothing to filter out noise. On the surface, that sounds like a good idea, but in practice, it introduces a lot of lag. By the time those indicators give you a clear confirmation signal, the market has often already made a big part of its move. That leaves you chasing price or entering too late. The Step Channel Momentum Trend takes a completely different approach. Instead of a smoothing, it uses what's known as a structure-first method, which is designed to cut through noise without falling behind price action. Here's what that looks like on the chart. The main element of the indicator is the midline, and you'll notice it doesn't behave like a typical moving average. Instead of curving gently, it looks more like a staircase. It stays flat until the market produces a confirmed pivot high or pivot low, and then it snaps up or down to a new level. This is key. It's not reacting to every tiny fluctuation. It's waiting for a genuine shift in the structure before making a change. That's how it avoids both false signals and unnecessary lag. Wrapped around this midline are two volatility bands. These are calculated with the ATR or average true range, which measures how much price typically moves over a set period. When the market is volatile, the bands expand outward. When things are quiet and calm, they contract inward. This way, you always have a real-time visual of market conditions, whether it's heating up or cooling off. One of the coolest and most practical features is the candle coloring system. When price climbs above the top volatility band, the candles automatically turn green, showing that bullish momentum is strong. If price falls below the bottom band, the candles flip red, signaling a strong bearish momentum. And if the price is stuck bouncing around in between those two bands, the candles shift to orange, which is your clear cue that the market is consolidating and momentum is weak. It doesn't get much more straightforward than that. Another thing you'll notice are the small diamond markers that appear on the chart. These symbols show you the exact pivot points that cause the midline to snap to a new level. It's a simple way to track the structural changes as they happen, so you're always aware of when market is shifting direction. Now, let's open up the settings. The most important input here is the length. This setting determines how sensitive the indicator is to forming new pivots. If you're a swing trader who holds trades for several days, you'll likely want a longer length value. That makes the indicator less sensitive, so it only reacts to more significant market moves and ignores smaller fluctuations. On the other hand, if you're more of a scalper or short-term day trader, you may prefer a shorter length value. This makes the indicator more sensitive, allowing you to pick on smaller swings and potential pivots much faster. The beauty of this is that you can tailor the tool to fit your exact trading style and time frame. Alright, so how do you actually put this indicator to work? The easiest and most obvious way is by using the candle colors to identify what phase the market is currently in. For a bullish trade setup, you'll want to watch for the candles to shift from orange to green. That change tells you that after a period of sideways consolidation, buyers are now stepping in and momentum is turning bullish. A common way to trade this would be to wait for the first green candle after the breakout, enter your position, and then place your stop loss just under the most recent structural low. From there, you let the trade run with the trend. For a bearish trade, the process is simply reversed. Watch for the candles to transition from orange to red. That shift signals that sellers are gaining control and momentum is pushing downward. Once you see that the first red candle, you should enter a short position, placing your stop loss above the most recent swing high. Another helpful aspect of this indicator is the role of the midline itself. Often during a strong trend, price will pull back toward the midline. Think of it as a magnet or an equilibrium point. In practical terms, this means you can use the midline as a potential take-profit target or even as a level to look for re-entries if you want to add to your position during a trending move. So to sum it up, the step channel momentum trend indicator gives you a clean visual framework of the market phases. By combining both market structure and volatility directly into its design, it helps you see when it's best to step aside, when momentum is strong enough to enter, and when to ride the trend with confidence. It's far less noisy than many traditional indicators, and at the same time, it gives you the flexibility to adapt it to your personal trading style. Of course, I want to emphasize that this tutorial is for educational purposes only, and not a financial advice though. Any strategy that relies purely on indicators should be tested thoroughly before being applied in live markets. Always combine this with your own analysis, whether that's price action, support and resistance, or fundamental drivers to make informed trading decisions. If you found this explanation useful, don't forget to leave a like. And if you want more in-depth tutorials like this, make sure to subscribe so you don't miss the future content. Thanks a lot for watching, and I'll see you in the next video.